Welcome to the Contrarian Capitalist podcast. I'm delighted to be joined today by returning guest Alasdair Macleod from the very popular Macleod Finance Substack. Alasdair, how have you been recently?
I've been fine, thank you, Robert. Thank you for having me on.
It's a pleasure to have you here and plenty to talk about. I should point out we might mention some pricing. We're recording this on the 4th of November, and this is likely to go out on Friday, the 7th of November. So apologies in advance if there's any substantial differentiation in the prices. Alistair, I wanted to start off with a recent article that you wrote called "How Will the Dollar Die?" And more importantly, the fact that you made a distinction between, well, there's one key distinction, I should say, between what happened between 1929 and 1932 and what's bubbling under the surface today. And it's to do with the connection with gold. So please do start there and elaborate on that if you can.
Well, there are two aspects. In that article, I showed how the gold price, if you like, moved very similarly to how it moved in Germany after the First World War. And as I'm sure most of your viewers know, that culminated in a collapse of the Reichsmark. And the collapse was absolutely total. So we should, if you like, worry about why it is that the gold price is rising on the same sort of curve, if you like, as it was in the later stages of that hyperinflation. I mean, by the later stages, I mean really from about late 1921 onwards. And I mean, the answer to this is quite simple, and that is that the dollar is, if you like, in the early stages of its final life as a fiat currency. Fiat currencies always come to an end. And the reason they come to an end is that governments, the issuers, if you like, of fiat currencies, use them to supplement their taxes. And it gets to the stage where the debt is built up to such an extent that the whole thing eventually falls over. And that's roughly what we face with the dollar. And of course, because we have a global fiat currency system based on the dollar, it affects all of us everywhere. Your reference to 1929-32, of course, it was the big Wall Street crash, the bear market after the roaring 40s, roaring 20s, sorry, when you had a similar credit bubble, but this one is far bigger. Also, you had the Smoot-Hawley Tariff Act, which imposed extra prices on imported goods. This time, we've got the uncertainty because a capricious president keeps on changing the numbers. But there is no doubt that the combination of a credit bubble and trade tariffs at the top of that bubble is a lethal combination. This credit bubble will pop. And the reason that we can see that the end of the fiat currency dollar is approaching is because we know what the response to the authorities will be when that bubble pops. Because a popping bubble basically means there's more risk in credit, which means that bond yields will rise, borrowing costs will rise for anyone borrowing overnight or whatever. It doesn't matter what the Fed says the the funds rate is. I mean, that's completely immaterial. But markets look at risk and they have to price that risk, and they will price that risk in the knowledge that the purchasing power of the dollar is falling because that debt is being monetized. It's actually already being monetized because the Treasury is relying increasingly on the issuance of T-bills to fund its deficit because the cost, if you like, of funding at the long end of the yield curve is just too great for it. And it's also found that there isn't really the demand out there along the yield curve, if you like, to support the level of financing. I mean, you've got the deficit, and also you've got all the maturing debt, which has to be rolled over. So there's substantial refinancing problems there. And it's being monetized, is really what it boils down to. This is very, very bad news, already being monetized. And then this week we had the Fed turning around and saying No more QT. Now it's going to be QE, and we're going to knock a quarter point off the Fed funds rate. So you can see that the Fed has switched from trying to manage the inflation problem to trying to stop the economy from sliding into recession. So put all that together, you can see how the ghosts, if you like, of the Reichsbank are on the stage now.
As they say, it's a case of history, not necessarily repeating, but certainly rhyming. So certainly something to pay attention to. I know that in the same article you started by saying, and I quote, commentators find it hard to explain why the dollar price of gold has soared in recent months, variously attributing it to risk aversion by nervous investors, speculation, and market seizures, end quote. Do you
Yeah.
think that really it's a case of people are reporting things like that in good faith and they just don't have the knowledge, or they're just not putting two and two together at the moment? What do you think?
Well, they don't really have the knowledge. And if you don't have the knowledge, you can't put two and two together. So it's the combination of that. I mean, bear in mind that the current cohort of economists, bankers, investment managers, whatever, are all trained in macroeconomics, which basically is Keynesianism. And so they don't actually understand economics. I mean, the whole of the Keynesian thing is a myth. It really is. It cuts out human action. And the idea that you can calculate and project from statistics exactly what the outcome will be is arrant nonsense. I mean, it really is. But they all, they don't have any substitute for that. That's the problem. They don't actually understand the legal position of gold either, because gold has been denied as part of the fiat dollar led system for 54 years. But the fact of the matter is that gold is everyone's um, money, if you like, without counterparty risk. And it's embodied in everybody's common law. So, this is the idea that gold is just a pet rock now, or, whatever they like to call it, is just pure propaganda. And of course, everybody's fallen for it. So there's a huge, great re-education, not just of politicians, but of their advisors, which is
Mm.
necessary before they can really tackle the current problem.
Yes, I do. A part of me does wonder that if that's by the time they get round to doing that properly, it's a case of too little, too late. But I guess we'll watch this space. Brings me nicely onto another article that you've written recently. I believe this was for your friends over at Von Greyer's. And by the way, congratulations on your new position there as well
Oh,
since we last
thank you.
spoke. Uh,
Yeah, thank
you
you.
mentioned about the importance of property rights and the confiscation of gold, and this is important because a lot of listeners for the Contrarian Capitalist are actually from the USA. So again, if you can dive into that article and bring to light what people should be paying attention
Yeah.
to and what might happen.
Yeah. I mean, basically, nowadays we sort of look back on the events of 1933, when FDR decided to, if you like, ban the ownership of gold, putting it very, very bluntly, and forcing individuals who held gold to swap it for dollars at the current gold standard, which at that time was 20.67 dollars to the ounce. Um, I mean, the point about it is that what he did was actually a clever way around property rights. Property rights are sacrosanct in an economy like America's. But at that time, we had an absolutely solid gold standard, which was de facto from, I think, about 1856, and de jure from the Gold Act in 1900. So there's absolutely no question that the dollar, at $20.67 was the equivalent of an ounce of gold. I mean, it was just absolutely simple. So using that basis, he forced everybody to exchange their gold for dollars. There was no confiscation. It was just an enforced swap, if you like, of property. So Of course, I mean, the fact that he subsequently devalued the dollar by 40% in 34 was, is a separate issue. I mean, that undoubtedly is what he had in mind when
Mm,
he forced everybody to submit their gold. So you can see that, it's a sort of, if you like, it's a bit of legalese, really. I mean, the effect was the confiscation of gold, but in legal terms, it wasn't quite, if you see what I mean.
mhm,
Um, I think it does actually inform us today. Would America do that again to its own citizens? I think not. I mean, the problem is that the gold standard, believe it or not, is at $42.22 to the ounce. So quite obviously, if the market price is $3,900 or whatever, and you're forced by executive order to exchange your gold at the rate of 42.22 to the ounce, that is actually definitely, you know, um, uh, stealing your property. I mean, it's or stealing the value of your property. Anyway, so one way and another, I don't think it's so easy to do now. I know everybody thinks that once bitten, twice shy. This has happened before, and therefore it might happen again. It might happen again. I mean, bear in mind that we could be talking about legal niceties when it comes to the future of gold ownership. So, these clever guys will probably find some sort of way to do it if they really were determined to do it. But I also think it's not in their interest to do it. I mean, there's a Chinese proverb: "The wise man sits on the hole in the carpet," you know, to to basically hide the deficiency in his house. So that's actually what they should do, and this actually is the policy of the U.S. Treasury. I mean, you had Scott Bessent going in and saying, we're going to do we're going to look at the gold in Fort Knox, whatever. We're going to do a survey. We're going to do a audit, all that sort of stuff. Of course, as soon as he's uh, in the Treasury, he's he's firmly advised, "I wouldn't do that if I were you, Scott."
mhm.
Shut up. You have to ask yourself why. It's a sort of question of shut up. I mean, there are two possible answers to this. The first is the obvious one that the official line has been that gold is now a pet rock. It's got nothing to do with the monetary system, so don't talk about it. That's one option. The other option is that actually there is likely to be a deficiency in the quantity of gold. So the report that they've got, 8,130 tons, or whatever the current figure is likely to be incorrect. And it's not just because it hasn't been audited properly. Um, I mean, you have to bear in mind that really from the sort of early 80s, when the LBMA really started going, gold was the basis of the carry trade in order to buy US T-bills. And so, you would go and lease gold, say, from a central bank, sell it into the market, apply the proceeds to T-bills, and so your cost of funding was roughly 1%, and the return you were getting was up to 10%. You know, and you leverage it up if you can, absolutely. I mean, this is a brilliant trade. But what happens to the gold? It goes into the market. Does it ever come back? Well, not really. That's the trouble. And Frank Veneroso, who is the analyst who did most work on this, he was also talking to people I knew in the old days, like Terry Smeaton at the Bank of England. I mean, his sources were top flight. They really were. He reckoned that somewhere between a third and a half of all central bank gold had gone out on lease and probably disappeared, if you like, not returned. So what you have, I mean, if you open Fort Knox, you probably find a whole bunch of IOUs sitting there rather than the real stuff. And of course, the other problem is that we wonder why it was that the Federal Bank of New York, which basically stores earmarked gold for foreign central banks, was so reluctant to return as little as 300 tons of the Bundesbank's gold to it. What was it, 10 years ago or 7 years ago,
Mm.
whenever it was? And there was I mean, it was, and not only that, but they wouldn't let the Bundesbank look at its own property. They were denied the right to go and have a look at their gold to check serial numbers and all the rest of it. Oh, no, 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 can't do that. So, there's definitely some skullduggery going on there. Um, I think that's the other reason, basically, why every Treasury Secretary is told, shut up, don't talk about it, off limits.
Oh,
So, anyway,
absolutely. It would, yeah, I agree. It's not like it would be a case of, oh, we're missing a ton or two. We're potentially talking, a significant number that isn't there. So that does make a massive difference. Alistair, in terms of, I just want to bring things closer to home for a second. Obviously, I know that a lot of things are US centric, and a question I had from a subscriber actually that I got asked to ask you, and I think it's a good one to ask, is in the UK at the moment. Of course, if you buy a Britannia or a Sovereign, there is no capital gains tax because it's legal tender. Now, we're seeing a lot of political discontent within the UK on numerous fronts. Do you think there would be a possibility at any point that they might change that so that even Britannia's are not capital gains tax exempt anymore?
um, it's, I mean, I think it's a very difficult question to answer because there are a number of legal hurdles to overcome. I mean, cash is not subject to capital gains tax, if you like. If it was, we'd all be claiming it on the basis
Yeah.
of its loss of purchasing power, if you could establish that. But I mean, this is a difficult one. I cannot actually rule it out, but I think it would be um, a very stupid thing to do, certainly from the point of view of the Treasury. I mean, I can't think of any more effective way of showing your bankruptcy, but by applying taxes on legal tender. I mean, this is something which I think. I mean, we were looking at sort of some pretty arcane law here. So, I don't know whether it would be possible. Might be possible. I don't know. But I mean, they've introduced VAT, for example, on silver coins. So, but that was not a UK thing. That was actually an EU thing. And now after Brexit, we didn't change that. Guess what? So, and I think also, really from the sort of central banking network, um, the idea of doing that, I think, actually would ring alarm bells, not just in the UK, but all around the world. It really would. This idea of taxing. I'm probably grasping at straws, and I wouldn't be able to really deny that. But I think it's unlikely, but not impossible.
No,
But the
fair
great
enough.
thing about it, the great thing about it is, how do you collect it? Because a sovereign or a Britannia um, is bearer money, if you like. It's cash, and you can't establish, that anyone's actually owns it. I mean, I could hand my sovereigns over to my children, if you like, and I should declare that, if you like, to the Inland Revenue as a gift or whatever. But if I didn't do it, I think they would have almost no means of checking it out. They really wouldn't be able to check it
Oh,
because
thank
it's
you
not,
for.
we're not talking about ownership evidenced in paper form, in contract form. We're talking about, it's if you like, as untraceable as a bundle of pound notes.
Well, thank you for answering that. I say that was along the lines of what I mentioned as well, that nothing's impossible, but I think it would be
Yeah.
difficult as well. Now, Alistair, we last spoke, I think, at the end of March, start of April. Since then, gold is up by about 33%. I think it would be a good idea before we look at recent price action and opportunities, etc. It'd be important to remind people of the absolute fundamentals here of gold. And if you do want to touch on silver as well, please do feel free to do so. So let's just remind people, what are the absolute fundamentals in play at the moment?
Yeah, you have to go all the way back to the first Roman law, which was the 12 tables in 448 BC. And for well over 1,000 years after that, jurors were ruling, if you like, on the basis of those laws and producing other laws. And it was particularly in the first and second centuries, really, well, second and third centuries perhaps, that three jurors, Alpin, Paulus, and Gaius, really defined the difference between money and credit. Now, money is final settlement. If let us say you pay someone for doing something in gold coin or silver coin, or whatever is regarded as final settlement at the time, then there is no counterparty. It is completely extinguished. If, on the other hand, you pay someone in pound notes, dollars, whatever, pesos, what you're looking at is merely the transfer of a liability, because it's the central bank's liability that you're paying in. So you're transferring that from you to whoever you're paying. And of course, the same is true of deposit accounts at the bank. The bank owes you, if you like. So the bank has the obligation, if you like, to pay you your deposit in gold. Well, we don't do that anymore, but you know what I mean. The basis is still there. So if you pay someone by bankers, by a bank transfer or whatever, then you are merely transferring that debt of the bank from you to someone else. It's not final settlement. And that is the difference really between a currency and gold. Gold is final settlement in everybody's common law, whereas a bank deposit or cash notes or bank reserves, as they call it on the central bank's balance sheet, all that is credit. It's completely credit. Now, if you tie that credit, the value of that credit, to that final settlement, which is really what you should do, then that credit becomes a gold substitute, if you like, technically, as a circulating medium. But if you don't have that facility, then the value of that credit can fluctuate depending on really the faith that people have in it. So this is really what's happening to our currencies now because of all the debt that's accumulating, because of the credit bubble, which when it bursts will really impact the stock market very badly and lead to huge, huge rescue operations by central banks and governments in order to stop their economies and their tax base imploding. What they will do basically is they will devalue that credit measured in final settlement, which is gold. It's also silver, but silver hasn't been a standard for a very, very long time. I think it was last a standard in China in 1968 or thereabouts. But silver was, I mean, it was set, the ratio with gold was set by Sir Isaac Newton, about 15 and a half ounces to 1 ounce of gold. And that was a long, long time ago. That was in the 18th century, early 18th century. And so silver, I mean, sterling, the pound was on a sterling standard, really until the time of the Napoleonic Wars, when what emerged out of that was the sovereign base, basically. Though there were sovereigns before that, but the sovereign as we know it today came out. It was first minted, I think, in 1817, 1818. And we went on to a gold standard, I think, in 1821. So the rest of Europe basically followed us a lot later. The rest of Europe was on, well, certainly Germany and some of the other countries, if you like, to the south and east of it, were on silver standards. But after the Franco-Prussian War, Germany managed to get paid reparations by France in gold, and that permitted them to go off the silver standard and onto the gold standard. And it was from that point that the ratio of silver to gold rose, and it just rose and rose and rose. In other words, the value of silver relative to gold fell and fell and fell. So, that's sort of brief history. Gold is obviously, regarded by central banks, who are the note issuers, as the standard now, rather than silver or even copper. I mean, copper was also standard. And if you go back to the early days of Roman law, at 448 BC, the coin was a pound in weight of bronze. It was called the ice. So it's, I mean, it's something that has evolved. Gold came in a lot later, but the whole thing was fixed in Justinian's pandects, which were in the 6th century, and then in the 10th century, it was confirmed in the, if you like, the Eastern Empire. Well, it was already the case in the Eastern Empire, but it was confirmed because the Basilica, which was, if you like, the Greek language version of common law going throughout the Orthodox Christian lands, that came in the 10th century. So really, the whole way from all the way across Russia, all the way to Portugal, which basically was originally part of the Roman Empire. I know that Russia extended a lot further than the Romans did to the east, but um, it really meant that all the nations which went out and colonized the world from Europe took their common law with them. And US, well, yes, the United States law, basically before they started forming their own law, they referred to Blackstone, and Blackstone was the, if you like, the vademecum, a lawyer's vademecum on common law in England. So it went over with Blackstone and remained the case, unarguably. So that's the history of it. And every time some ruler attempts to detach his currency from gold, always with a view to expanding it without having the responsibility of paying final settlement, its currencies always fail. This will fail for exactly the same reason. And you can see with the debt buildup how close we're getting to it. And when this bubble pops, you can see how they're going to really accelerate the printing press. It's going to make the Reichsbank look like a tea party. It really is.
Yes, it's, yeah, that's going to be very interesting, I think, to watch if you certainly don't have any exposure to physical gold itself. Alistair, just to have a look, bring things, I say a bit more up to date. What I mean by that is let's have a look at what's been going on very recently with regards to silver and gold. And yeah, we saw a fantastic month, October. Obviously, the price skyrocketed. It's dropped down since then, and I know that some people might get a bit disillusioned by that, but ultimately, as you've just clearly laid out, the wheels are in motion. This isn't going to stop anytime soon. So actually, a bit of sideways movement, maybe a bit of a retraction in the price of gold, is quite possibly a very healthy thing at the moment.
Well, you're looking at it as an investor
Mhm.
is wrong. But I mean, that's how everybody looks at it, to be fair. Um, and when you see, sort of, the LBMA attendees at the annual Beano reckoned that they all came up with their forecast for 2026, and the average was just under $5,000. So you can see that people are now talking it going higher, but they don't understand why, quite frankly. I mean, it's, as you said in the introduction to this, in another article I wrote, how people sort of think, well, it's a bit of unwinding of speculative positions, and you've got um, a bull market that pauses and so on. But it's not a bull market in gold. This is the whole point. It's actually a bear market in currencies. You've got to look at the other variable, if you like, in any pricing, and that is the currencies. The currencies are going down. Now, nothing happens in a straight line. We'll admit that. But basically, if you want to trade this, then your life is in your own hands. And if
Mm.
you want to trade it, basically you're up against some very big people with very deep pockets. Little old you will get wiped out, I can assure you. So this is not a market for trading. It really is not. I mean, you can go to bed at night and say, "Oh, I've got a nice little profit." You wake up in the morning and find they bashed it. Why they bashed it? Well, it's got nothing to do with fundamentals or anything like that. It's got to do with book positions.
Hmm.
And if they think they can shake you out, they will do so. So by the same token, I don't get in the business of making price forecasts. All I can do is I can tell you why things are moving, not how far they're going to move at any one, in any time frame. But stackers should be rejoicing. I know what will happen. Most small people, by I don't mean that in terms of stature, but I mean that in terms of funds, will be, they will be disillusioned if they see the gold price fall back to, say, 3,600 or 3,500. Well, the answer is that basically nothing has changed at all. Governments are being horribly irresponsible. Their situation is getting worse. I guess that the moment will come when that credit bubble pops. When the credit bubble pops, you start seeing equities falling, you start seeing bond yields rising, and at that time, I don't know. I mean, if you're terribly worried, you might sell some of your gold because you're not thinking in terms of final settlement and credit. It's credit where the risk is. If you sell gold, you're buying credit. Do you really want to do that? No, this is, I mean, I think that the right attitude to take is, a setback like this is a gift for stackers, a gift for people who perhaps might have missed the boat a bit. They need to get in and protect themselves. This is a time not to sort of speculate to accumulate, which is the attitude. It's a time to protect what you've got. It's as simple as that.
Oh, well, thank you for making that distinction as well, because I know that we're going to have all sorts of people that are going to be listening and watching this as well. And some people might think too much about the price movements, but what I really enjoy about yourself and your message is that, and I mean this in the best possible way, is it's in layman's terms, as in this is not necessarily, gold is like this because fiat currency is like this. And I think once you break everything down and you put it as simply as that, I think that then should make it a lot clearer for everyone listening to this video or
Yeah.
watching
I
this
hope
video.
I hope so. Yeah, because that's what we were trying to achieve. Sure.
No, absolutely. So, for anyone that is, shall I say, concerned about any recent price movements, ultimately, as long as you believe that they're gonna, fire up the printing presses, so to speak, then this has a lot of room to run, and it could go anywhere. Who knows where it could go. Alasdair, is there anything else that people need to take into consideration given that, the geopolitical macroeconomic landscape at the moment? Anything that we haven't spoke about that you want to bring to people's attention?
Well, there is another aspect to this, which I don't think is getting any headlines at all, really, and that is that the whole of the commodity um, complex looks like it's turning a corner, which basically means there will be higher commodity prices going into 26 and into 27. The other aspect is that I think markets are very, very, I don't know, they're looking at things in completely the wrong way. Everybody's sort of muddling along, thinking that interest rates will continue to fall and thinking that inflation won't be a problem next year. A lot of these people say that inflation isn't going to be a problem because the economy is soft, it's stagnating, whatever, it might go into recession, and therefore demand will decline. Well, it's an idiot approach because if you get demand declining, the root of it is because production declines. So, you find that supply and demand in most cases tend to sort of go down together. And of course, what people don't look at is the value of the currency. What is the purchasing power of the currency? I mean, as I tried to make clear earlier on, it's it's absolutely obvious that when this credit bubble pops, and if you don't understand it's a credit bubble, just look at the debt side, because debt equals credit. It's two sides of the same coin.
Mhm.
This is a massive, massive credit bubble. It's the largest recorded in history, in financial history. When this one pops, I can tell you that share values, I forget fundamentals, forget momentum and all the rest of it. Share values will literally collapse. Now, maybe not overnight. I mean, the big bear market in 1929 took 3 years. Well, yeah, 2.5 years. So you can see that this is a trend which starts, and when it continues, then you've got banks which have collateral in the form of shares, which no longer cover their loans, so that you get sold out. That drives the prices down even further, etc., etc. And you find that the risks involved rise. If you really believe that the central bank controls the price of risk, then I'm afraid you better go back to school because that's not the case. It really is not. You will find that as lending risk increases, then you will find that, you know, if, let us say, the Fed lowers interest rates to 2%, the banks will only lend at something which will be rather like a sort of payday loan. I mean, this is, you know, because from their point of view, they don't want to lose. They don't want to start writing off loans. So, I mean, they're not going to, I mean, basically, they won't lend. That's the way they will deal with it. You've got all those big zombie companies too. What's the government going to do about that? Well, it'll support them. It'll support everything. It'll try and support the whole lot. I mean, we had the lesson in this one from Bernanke back in 2008-9. He basically wrote a blank check for the entire US banking system, which I calculated at the time could be a potential open-ended commitment, circa $14 trillion. Now, at that time, that was almost double the level of debt, US government debt. That's what they do. That's the mandate. That's what the politicians require a central banker to do. And it's what the Treasury will do. I mean, obviously, they will try and persuade Jamie Dimon to take over this bank, that bank, and all the rest of it for a peppercorn. And Jamie Dimon will probably do it, but he'll probably chuck out the bits he doesn't want in the process. So you can see that what this boils down to is a massive, massive debauchement of the dollar. So what does that do to the purchasing power of the dollar? It goes way, way down. What does it do to interest rates? They go way, way up. What does it do to the price of gold measured in dollars? Way, way up. And at this juncture, you get shaken out by a little local turbulence. I mean, come on, this is stupid. Absolutely stupid.
Oh, I think, Alistair, that's a very good place to wrap up. And I think that's a really important message for anyone that is, again, listening and watching this that does get carried away by small price movements. You have to remember the bigger picture. You have to remember the fundamentals, which you've gone through very succinctly as well. And as you said, there are two sides to every coin, pardon the pun, as well. So we have to look at it from both angles as well. I will link to another article that I know that you retweeted, which is to do with the fear index. That is now reaching levels not seen since 2008, and we all know what happened back then. Alistair, as usual, I like to give everyone the opportunity to say how they could be found online, etc. So, by all means, the floor is all yours. How do people get in contact with yourself and find out more?
Yeah, well, basically, I write my own Substack, and it's macleodfinance.com, and everybody's welcome.
And I highly recommend people head over there. I am a subscriber myself, and the articles are always uh, very well worth a read. Alistair, it's been a pleasure to have you back on. I look forward to catching up again in 2026.
Lovely to speak to you again, Robert. Thank you.